So the name of this presentation is Towards Free Lunch. And you probably heard about this saying by Harry Markowitz, as a Nobel Prize winner in economics. And he said, the only free lunch in finance is diversification. And this is what we're talking about today. So, I mean, a lot of you who are into systematic trading, they have obviously seen a lot of talk about AI and trading signals and so on. But what people often don't realize is that things like diversification can actually massively improve your performance strategies without even having any of these fancy trading signals and so on. And, you know, while I'm obviously subscribing to some of this more complex technology, often actually presenting some of the basics that make your trading performance, especially out of sample, better, is worthwhile showing. And so today I'm doing this, and I'm doing this in a Jupyter notebook. And what I will do is actually show you some live coding examples so you can really follow it along and see, hey, this is actually how it's done. And so what are we learning today? So first of all, we look into how we can quantify diversification, because we want to get an idea of what diversification is and what it actually looks like in real life. And then we have a look why it is important, of course. And then what I also want to show you is why optimization strategies often fail. So, you know, optimization is obviously everywhere. So we have mean variance optimization, we have parameter optimization, and so on. And often we find that out of sample, the strategies actually don't work very well. It's basically overfitting. And the underlying diversification is one of the big reasons why they fail. And so how can we use this idea of diversification to boost our strategy performance? So I show you a little bit about this as well. And hopefully you get a nice sense of how this actually works and what this means. Now, in order to get started, I use market data from Y-Finance. So I install Y-Finance on my system here, as you can see. And then I just import a few Python packages, and they're just really simple packages: NumPy, Pandas, Matplotlib, and Optimize. So Optimize is really for running some optimizations. Oh, by the way, if any of you, and I just want to say this again, if any of you has any questions in between, please feel free to interrupt me, and I'm more than happy to answer them. All right, so what I'll do here is I just copied and pasted some of the top names from the S&P 500 from a website that just hosts the S&P 500 components. And then what I'll do down here is I'll just scrape the company tickers from the strings. So I'll just basically extract these ticker symbols here from that. And then what I can do is I can actually download these components. So you can see out of those 43 components, we can actually download about 33. And we split these into two categories. One is the in-sample period, which we choose from 2015 to 2020, and then out-of-sample period from 2020 to 2025. And so what I'll do here is I create two portfolios. And you can see on the ticker symbols that the first one, and I call it REDS or REDS2, is basically tech stocks: Apple, Google, Amazon, Microsoft, Meta, Adobe, and Tesla. And the second portfolio is a diversified portfolio. So we have a few diversified companies such as ExxonMobil, Wells Fargo, Costco, Pepsi, and so on. So they're quite different companies in a diversified portfolio. And what we do is we mainly need the returns of these. So not so much the prices, but we actually look at the returns of these companies. And so once we've done that, I want to talk to you a little bit about where this idea of a free lunch comes from before we get started. And so free lunch is basically based on this idea of Grinold and Kahn call it the fundamental law of asset management. And you can see the equation here. So this equation isn't an exact equation, but it's more of a guideline of how asset management works. And it's the information ratio which is in a sense equivalent to the Sharpe ratio or the risk-adjusted returns, equals DIC, which is information coefficient, times the square root of breadth. And information coefficient is basically, we could say roughly, is the skill of a portfolio manager. You know, when you are a good portfolio manager, you kind of know how to analyze this. Let's just say Warren Buffett, he obviously has a good hand in analyzing stocks, let's say. And so he's got a high skill level. But at the same time, we've got breadth as well. And breadth is effectively how many different products or assets you have under management. It could also be in a breadth in time, but let's leave that out for a moment. So let's just say you have a high skill level, but your breadth, let's say in the case of Warren Buffett, is quite low. So you only have, let's say, 10 or 20 stocks under management. So in order to get a high information ratio, you basically need a very high skill level or information coefficient. On the other hand, if your skill level is not so high, but you actually have quite a large breadth, you can reach the same information ratio, but just by a lower skill level and more broad assets under management. And this is effectively where the free lunch comes from, because when we have, and this is clear, breadth only works if the assets that we have under management are well diversified. If they're all of a similar nature, then we don't actually have any breadth, which is quite obvious. Let's just have a look at an example, make it fairly clear. So what I have done here is, I have two small portfolios, and the first portfolio is consisting of Google and ExxonMobil. They are two quite different companies. And the second portfolio is the S&P 500 ETF, the SPY, and the Nasdaq ETF, the QQQ. And those obviously are quite similar. A lot of them in those two indices have the same components, and so they are quite similar. And so what we can do is we can take the returns of these two different portfolios and plot them against each other. And so let me do this here. And this is what we can see. So the orange one is the QQQ SPY, and the blue one is the Google and ExxonMobil. So on one axis, we have ExxonMobil, on the other Google, and in the other case, on one axis, we have QQQ and SPY. And what you can see is really interesting. So SPY and QQQ, the orange ones, are extremely highly correlated, while the other portfolio, XOM and Google, is not quite so correlated. So what can we say here? Basically, if we look at the linear regression, for example, we can see that it's very also the distribution of the points follows into a very narrow range, while the distribution of these points follows in a much broader range. And if we see this, we can basically say, okay, the blue portfolio is much more diversified than the orange portfolio. Now, the question is, how do we quantify this diversification? And it's not necessarily obvious how to do this, because, you know, we need obviously some mathematical tools. And so one of the tools we could say is, well, we've got a variance in the direction of the, you know, of the linear regression, let's say here. So if we take a linear regression, we draw a regression line here. And then if we take the 90-degree angle to this, we can see that the maximum variance along this axis is much smaller. And so in the second case, the relationship between the axis in one direction versus the axis in the other direction is, you know, is a bit larger, or, you know, so there's a different ratio. And this works quite well for, let's say, we generalize this for more assets. And one of the ways to do this is to use principal component analysis. So principal component analysis decomposes portfolios into various factors. And to understand this is not actually that difficult. So for example, in the case of two assets, you can see that one factor is basically the regression line along here, and another factor is another 90-degree line in this direction. And so if we have multiple assets in a portfolio, we obviously work in a higher dimensional space, so we can't have visualization of that anymore. But it's the same thing. We're actually drawing these lines, and they're all in right angles to each other. So in this case, we've got 2 lines. If we have 5 assets or 6 assets, we have a 6-dimensional space, and we've got them all in right angles. And then what we do is we look at the relationship between them in right angles. And then we can do something with it, and we can actually quantify the diversification of our portfolio. And this is really quite important, because what we will see later, a lot of the time when we do an optimization, what happens is that when we optimize our portfolio, we're actually lowering the diversification of our portfolio. And while this gives us good in-sample results, out of sample, this can actually be very detrimental. And often you will have probably seen this when people talk about, say, mean variance optimization and how it works really well in a backtest. But as soon as you go out of sample, it doesn't work so well anymore. And I will show you later on why that actually is and what we can do about it. All right, so let's just do a principal component analysis. And principal component analysis is a little bit like a regression. So it basically decomposes those data into different factors. And we can actually do a principal component analysis by hand. We don't even need a tool for that. For example, sklearn provides a tool to do principal component analysis, but we can actually do it ourselves. And it's fairly simple. So what we can do here is we take our values here. So for example, reds. So we go reds. And then what we do is we subtract the average values from that. And Google is already suggesting that. And then what we can do is once we've basically regularized it or subtracted the mean, so our returns are actually centered around 0, we take the covariance matrix of this. So in this case, we've got 1, 2, 3, 4, 1, 2, 3, 4, 5, 6, 7 products. And so we have a 7 by 7 covariance matrix. And the last step for our principal component analysis is just simply, we do this thing, numpy.linalg.eig. And eig basically is a function that calculates the eigenvectors and the eigenvalues of the covariance matrix. Now, if you want to go quite deeply into the mathematics of it, then I recommend just using YouTube or something. There's a lot of websites that talk about this. And so what I'll do here is this function actually produces something called the eigenvalues and the eigenvectors of this. And so if we run this, we can actually see there's 2 matrices. So there's eigenvals. So eigenvalues is a vector with 7 entries, and eigenvectors is a 7 by 7 matrix. So evex. So you can see here, this is a 7 by 7 matrix. Now, for our purposes, all we need is the eigenvalues. And why? Let's just have a look at these eigenvalues. Eigenvals. And so you can see they have different numbers here. And basically what the eigenvalues describe is the size of the variance in each of those orthogonal directions here. So for example, if we take this, we would have quite a large eigenvalue in this direction, along this line here, along this vector, but a much smaller eigenvalue in this direction. And basically what that tells us is we can, in a sense, describe the relationship between SPY and QQQ almost entirely with one factor. Whereas in the other case, between Google and ExxonMobil, we've got fairly large eigenvalues in either direction. And so it's not quite as easy to describe the relationship between them with just one factor. We really need 2 factors. Now, in the case of this, we actually have 6 factors. And so one of the things we can do is to, first of all, sort these eigenvalues along their sizes. So what we do is we do np.sort, and then what we do is we start from the largest one to the smallest one. So we just invert this vector here, this sorted vector. Now this is just for visualization. And then what we do is we take the cumulative sum of those. And so you see in a second why we are doing this, because now if we plot this, we can see that we get this thing called the explained variance. So we're actually now seeing that, we have, a certain explanation here, and then our next factor explains it a little bit more and so on. Now, the issue with this is that this doesn't actually tell us much, because we have we have just some random numbers here. So what we actually want to do is we divide this by the sum of the eigenvalues, like this. And then we can see is that we've got our 7 factors here. And so our first factor explains about 52% of our portfolio, and then our portfolio, so 77 or so percent of our portfolio are already explained by 2 factors, and then obviously all the factors then explain all the portfolio 100%. And so the interesting thing is what we can see by the way this curve behaves is we can actually tell how diversified it is. So for example, if our first factor can already explain almost 100% of our portfolio, then all the other factors will have basically very little explanation power. And this means our portfolio is not very diversified. And on the other hand, if this is more of a straight line, then our diversification is much, much better. So let's wrap this into a function. And then we can actually run this for various products. So we call this define explained variance EV, and we do this, and we go into returns, and then we can run it, and we can actually run it for example 2 different things, and then plot it. So let's just do this. We could say plot EV, hold on, plot EV reds, okay, and then we do plt.plot EV, and you remember we had this other thing called div up there, which is our more diversified portfolio. So let's plot this as well. And let's just make our bullets a little bit nicer, just so we can see what's going on. All right, so what you can see is that we've got, I made a little mistake here with the red, and array must not contain nans. So
I think that is still the red thing.
What is it?
The red.
Oh, yeah.
Yeah, because you still have the S.
Thanks for that.
Yeah.
Okay.
And then in the definition line, it is EV red that you're lacking.
Yep. So, here we go. This is the tricky part of live coding. Sometimes you have to talk and think on your feet. Thanks for your help. I really appreciate that. So, all right. So we can already see this very interesting thing here, that one of the lines is actually a lot less steep than the other one. So this line, the blue line, is our less diversified portfolio than this one. By the way, again, if you have any questions, please feel free to ask. I know this can be a little bit daunting at times, but yeah, if you have any questions, it's really useful if you ask them. So basically, we've got these 2 lines now, and we can obviously see that, hey, this line, because it's less extreme, it's more of a straight line than this. We are more diversified. But how do we really quantify this? And that's really an interesting one. And so one of the things that we can do is we can effectively plot this as a double logarithmic plot. And that way, we can get a better sense of what this is doing. So one of the things we can do is, because we know that, we have 7 components, we just add numbers to them. And so what we do is we run this again. And so we assign the components 1 to 8. So we can also divide this by 7. And then what we then get is basically a normalized way of plotting it. You can see it goes from 0 to 1. And then what we will do is we take the logarithm of this, p.log. And as you probably know, if you use a double log plot, you can then actually plot some power relationships in a straight line. So that's what we're doing here. So we're doing a log. And here as well. So sorry about this. My typing can be a bit slow. Okay, and so what we can see here is now our lines are a lot more straight. And this is nice because when we do this, we can then actually run a linear fit of these 2 lines. And then we can say, well, whatever has the steeper slope, and clearly this orange one has a steeper slope, is actually a more diversified portfolio. And so we have a way of actually quantifying the diversification of our portfolio. And this is really quite an amazing tool to do. So let's do this. So we just do a linear regression. So we can use just polyfit for this. And let's do this. Let's just copy and paste these numbers from here. So we use polyfit. And so if we run this, we can actually see polyfit gives us then the slope and the intercept. And we can see for our first one, for our less diversified portfolio, the slope is 0.3. And for our more diversified sorry, this was not ideal. So let's just copy that. And then we go div, and we do this. And we can see that for the second one, we've actually got a 0.42 as our slope. So that's much higher. So this is a great way to quantify the diversification of our portfolios. And we can see that our diversified portfolio obviously gets a much steeper slope than the second one. And this is really great. So you can see here, I've got those headings. And unfortunately, now I'm just running it and they're not perfectly fitting anymore. So what we actually should do here is run the diversification measure in this. And so we can get this here. So again, if we comment out this line, we get the first one. And then here we get the second one. So this is the first thing we can do, is we can actually say, well, our assumption that this diversified, or this portfolio which we thought is more diversified versus the pure tech portfolio, is actually quantifiably more diversified using this metric here, principal component analysis, and then the slope of the log-log plot. Okay, so the next thing I want to do is, and this is where this becomes interesting, we want to look at what is an optimization such as the mean variance optimization doing to our portfolio, and why is my mean variance optimization sometimes not such a good way to deal with out of sample returns? Because you may have seen this, some people, they believe that a 1/n or just a pure risk parity portfolio are actually much better ways to run a portfolio rather than trying to optimize it for mean variance. And so how does mean variance optimization work? It's basically optimizing the portfolio weights for the Sharpe ratio. And, some people use what you call convex optimization for it, and that can be quite complicated, but actually a simple mean variance optimization can purely be accomplished by a standard Python optimizer. And that's what I'm going to demonstrate to you now. So the first thing is we just define a Sharpe ratio metric. So we say, well, WR, and then how do we actually define the Sharpe ratio? So normally if we assume that we have a pandas thing, then we can say S equals R dot, and then we multiply this by the weight. So we multiply our return columns with the weight vector, and then we take the mean divided by, and then here I already get this, R multiplied by the return vector with the standard deviation. And then we multiply this by 16, which is the square root of 252, which is the number approximately of the trading days a year. And then what we do is we return our Sharpe ratio. Now, what I'm going to do here is I'm actually returning the negative Sharpe ratio because this is what we need later on for our optimization. And so we can actually run our optimization with this Sharpe ratio as the objective function. So let's just have a look now and calculate the in-sample Sharpe ratio of our returns. So what we could do is we could do a Sharpe, and then we got a weight here and then reds. And so what we need to do is we need to define a weight vector. And we just say that we have equal weights. So we can say it's np.ones and the length is 7. And then we could, if we wanted to, divide it by 7 as well. So we come out with ones. And okay, one of the things we haven't done here is actually we need to, we want to calculate the portfolio Sharpe overall. So we actually have to sum up our column, our rows. So we do a sum x's equals 1. Otherwise, we get the Sharpe ratio for each individual component. Dot sum x's equals 1. So, and here we got it. So our Sharpe ratio for the non-diversified portfolio is 1.33. And for the diversified, it's 0.93. So why is this? Obviously, tech stocks have had quite a strong boom, especially in the 2015 to 2020 times. And so we would expect the tech stocks to be, to provide a higher Sharpe ratio. Now, the other thing is, we regard often the S&P 500 as an index. And so I took a number of these products from the S&P 500. But what the S&P 500 actually really is in a sense, a momentum strategy. We always take into the index the highest market cap products and we take out the lowest market cap products. So there's a constant reshuffling. So we see this as a strategy. And the other thing that I need to mention is when I select these stocks here, in a sense, I selected them from the recent S&P 500. So you have to understand that what I've done here is I have actually introduced a little bit of a look-ahead bias into this because I have actually selected stocks from a more recent S&P 500 rather than from the one, let's say, 5 or 10 years ago. Now, for our demonstration, this is just good enough because we're not actually building a trading strategy here as such. We want to mainly look at the effects of diversification. But you have to understand that this is actually what's happening. So I haven't actually managed to easily get components of past S&P 500 portfolios. So I had to use a more recent one. And this is basically why I did this. Okay, so now that we can see that we have a quantified Sharpe, we can actually now run a mean variance optimization. And that's not too hard to do. So in SciPy, we have a minimize function. And so what we do is we introduce our Sharpe function here. We use our W. So this is x0 is basically our starting value is our W. And then it says here arcs equals red. So again, the AI is giving me already some good suggestions. So we're basically now ready to do our optimizations. So, and then we get the results. So I call them result R and result D for result return, result diff. So let's see if this runs. Yes, it has. And let's have a look at the results. So let's just look at res R first of all. And what we can see here is it's optimized it from 1.3 to 1.57. And the X is basically our portfolio components that we get. And for res D, so it's actually optimized to 1.56, which is almost as good as the other one. And again, this X here, this is actually our optimized portfolio weights. And so what we can do is we can now take these weights and apply them to the out of sample data, which we have already produced. So that's the data from 2020 to 2025. So firstly, we apply this optimization to the out of sample data, and we look how does the Sharpe ratio evolve from in sample to out of sample. And then one thing we can actually do is we can then quantify the diversification of the two, of the unoptimized and of the optimized. And what we can see is when we do this, and so we'll quickly do this, that we will probably have less diversification for the optimized than for the unoptimized. And why is this important? Well, first of all, we don't know yet whether we get a better Sharpe ratio out of sample and so on. And it might be that we do actually get a better Sharpe ratio out of sample than we would if we don't optimize it. But what also happens is when you have trading strategies that you optimize and that suffer from a lack of diversification going forward, the trading strategy will become a lot less robust, or in other words, it will become brittle to market conditions. So a more optimized strategy, a more diversified strategy is just a lot more robust. This is basically what the free lunch means. We always have to think about what happens when we go forward out of sample. And in order to basically get the best results that we want, well, optimization can help. But if we pay the price in much, much lower diversification for our optimization, we'll most likely make our strategy a lot less vulnerable to market conditions. And this can be obviously a big problem. So let's have a look and let's see if we can quantify the out of sample portfolios. So what we do is we basically need to calculate the Sharpe. And what we do is we take our out of sample conditions here. This is reds2 and diff2. So let's just do reds2 first. So it's reds2. And then we multiply this by the weights that we got from our optimization. So res_r.x. And we can see that we've missing one required position. Oh, sorry. We actually need to put our res_r.x in here, and then we can run it. And so we can see the out of sample performance is 0.55. When we actually look at the out of sample performance for the normal portfolio is actually 1.0. So we can already see that the out of sample performance for the optimized portfolio is actually quite a lot lower than the out of sample performance for the unoptimized portfolio. So that's quite interesting. And let's do this for the other portfolio as well. So first we go with the unoptimized, and we can see it's 0.89. And then we go for the optimized. So that's resd.x. So that's the weight of the optimization. And we can see it's 0.7. So you can always see this negative factor here. And the negative is just really from the optimization. What we should do is, in order to get a proper Sharpe ratio, we should just go with negative here. And then we get a positive value. So you can see in both cases, we optimized the portfolio before, and then we ended up with a lower Sharpe ratio going forward than we would have if we had the equal weights. And so I think this is really, really interesting. And the question is why? And one of the reasons for this is because when we do optimization, we actually end up really tilting our portfolio towards a specific factor or towards a specific asset. And we get quite concentrated in one asset and we lose this diversification. So let's just have a look at the diversification behavior of those two assets. And so what we could do is we can actually use these functions here and just run the, so please ignore those headings. I built them for my own, I'm following up, and then now I'm not using them very much. So I apologize for this. So what we can do here is we can do reds2 and then div2. And what we can do is we call this, let's call this div1 or div-r. Let's call it div-r, diversification ratio 1 and diversification ratio 2. So this is basically the diversification ratios for the unoptimized assets. And what we can see here is this is in fact is the first, we need to only look at the first value here, which is the slope. So we can see that the slope, you know, is 0.24 and 0.33 is actually a little bit lower than previously. And now what we can do is we can do the same and actually multiply this by res_r.x. Have I got enough brackets here? Looks like it. So, and this one we multiply by res_d.x. And so what you can see here now is that the diversification ratios are actually a bit lower than we would had previously. So it's 0.3 and 0.311. Actually, this is probably not so good for comparison. So let me just add a bit of code. And we just do W here. So you can see here, this diversification actually doesn't change very much, but this one definitely does. So this is the equal weighted portfolio. So from equal weighted to optimized, it drops a little bit. Here from equal weighted to optimized, it actually drops a lot. So we definitely can see that our diversification actually really degrades quite a bit. Now, what I want to do is I want to just open it up for you for a few questions, because you probably have a few questions here. I mean, it's a fairly complex topic. So is there anything anyone would like to ask? Please do, because, you know, I really want you to understand it. Anyone? Not yet? Okay. Well, if everything is clear, then, you know, feel free to just jump in and ask. So.
Hi, Tommy. You actually have a question in the chat that says vectorized backtesting, how to live trade, how to rebalance.
Okay, cool. Vectorized backtesting, how to live trade, how to rebalance. So that's a different story. I mean, obviously, vectorized backtesting is just to make sure that, or to see whether we get a good strategy that has some promise. And then if we want to turn this into live trade, we can't actually use a vectorized backtest as such. If we want to do a live trading environment, then we have to basically turn this into what we would call, say, a loop backtest. And then we make sure that our loop backtest agrees with the vectorized backtest as much as possible. And then in the loop backtest, we can then produce the strategy weights. And once we've produced them, we can actually supply them to the market. And so this is how we go from vectorized to looped. But this is not really the topic today, because today I want to talk more about strategy research. So if you're actually thinking about this, how to take a vectorized backtest to live trading, maybe we could do another seminar if anyone's interested. So what can we do to actually get, to actually even boost our out of sample performance a bit more without, without losing the robustness of our trading strategy? And so one of the interesting ways to do this, and I'm not saying this is a surefire method for everything, but it's definitely something you could consider, is to actually optimize for diversification. So let's just assume you have a few underlying trading strategies, and they're all, a bit similar, but a bit different. So rather than just running them, one thing you could do is you could actually weight them in a way that you achieve the most diversified set of underlying strategies or products that makes your out of sample performance as robust as possible with the maximum diversification. Now, when you optimize for diversification, really the assumption is, to start with, that you do actually have something that has some alpha. So if you have strategies that don't produce any alpha at all, any profits, so to speak, then most likely that won't work. But if you have strategies that actually do have some alpha and you want to optimize your out of sample performance or improve your out of sample performance, make it more robust, then this could be a really nice way to do it. Now, I said before that the S&P 500, for example, is already in itself a strategy, if you will. It's a very simple strategy. It's just using or ranking the top 500 stocks by market cap and then putting them into the index and weighting it accordingly. But in a sense, that's a strategy. And so what we can do is we can say, well, we take the strategy of the S&P 500, and then rather than optimizing it for the Sharpe ratio, we could say, well, why don't we see if we optimize it for diversification, and maybe we get a better performance out of this. So we've already seen that if we do it with equal weights, we already achieve a better out of sample performance than when we do just a very crude mean variance optimization. I mean, I have to say, though, that when I did this mean variance optimization, this was for a 5-year period going forward. So that's actually a very long period. And then it's obviously not how it's normally done. You would only optimize, say, for a month or at the most a year, but not normally 5 years. But as this is a demonstration and we only got an hour, I can't obviously go too far into the details here. But the important thing is that you understand the example that I'm giving. So we use this principal component analysis for diversification, and I want to show you another tool that you can use for this. Is actually called the diversification ratio or the diversification coefficient. And this is what it looks like. It's sigma is basically our volatility times the strategy weights. And this is divided by the square root of the strategy weights. Then this capital sigma here is our covariance matrix, and then another weight. So that's basically a way of dividing the volatility by the correlation matrix, if you will. And this is and that weighted by the strategy weights, and that gives us a ratio that is also somewhat descriptive of diversification. Now, the reason why I didn't show you this in the first place is that while it is descriptive, it is not as good as using the principal component analysis, because this measure is very subject to portfolio sizes and all sorts of things. So if you compare two very different sized portfolios, it will not actually give you great values. This is more to compare like with like, and then it can be useful. Whereas with the other system, that can actually be still quite useful, even if you have different portfolio sizes and so on. So it's important to understand usually the tools that you use and the thinking behind them. And if we can do this, we can actually then build a maximum diversified portfolio. I can hear someone. Is there a question? Please just feel free to jump in.
Yeah, Tom, for the volatility vector, how do you calculate that?
How do you calculate what?
The volatility vector?
I'll show you in a moment. This is what comes next. So how do we calculate the diversification ratio? So this is actually a little bit of linear algebra. So what this is actually sort of dot products. All of these are dot products, basically. And it's fairly straightforward in Python to run dot products. The only issue is that Python uses the reverse notation to mathematics. Mathematics is usually column is first and then row is second. And in Python, it's row is first and columns. So it will look a little bit different. But let me just show you this. So just to answer your question. So what we can do is we can basically use this. And then what we do is we can use our returns and the standard deviation of them. So what we have here is basically a dot product of our weights and our standard deviation vector. Now, what does the standard deviation look like? For example, so let's just say reds.std. So you can see this is just a vector of that, right? And if we do this dot product reds.std, we will basically get the portfolio standard deviation here. Okay, so I'm wrapping this into a function, so I'm not actually doing this yet. But what we then do is we take the square root and we can then go. So first of all, you see this is the square root here. And then we do a dot product. And then we have effectively our WT. And then we take the covariance matrix. And then we need another dot product, which basically then does this with the weight again. So we do this. And now I just got to get my brackets correct. And this should be that. And we do reds. R is not defined. Okay, reds. All right, and so here we get the result. So this is the diversification ratio or diversification coefficient for our in-sample undiversified portfolio. So let's just do this for divs. Oops. Oh, div, not divs. Okay, so you can see this is our more diversified portfolio. It's got a diversification ratio of 1.54, and the other one, the less diversified, has 1.36. Okay, and now what we can do is we can actually wrap this into a function and then run the same optimization as the mean variance, but instead of for mean variance, we do it for the diversification ratio. So we can just wrap this and we call it, let's say, diff-rat diversification ratio. And we have, again, W and R. And then what we do is we return this. And we have to, because we're working with a minimizer, we have to do this, make this negative again. Oh, here's raise. It should be just R. And then we change this into R. And so we can now calculate our diversification ratios for all sorts of cases. For example, for our out-of-sample optimized portfolio, so this would be res r.x and reds2. So we're missing a colon here. So you can see that, for example, our out-of-sample optimized portfolio has a very low diversification ratio. And that's basically what we would expect. And then if we do this for our divs too, so our originally diversified portfolio, when it's optimized, it's also got a much lower diversification ratio.
Hey,
So
Tom.
if we, yeah.
Should we use res D, not res R for diff 2?
Oh, sorry. You're absolutely right. Sorry about that. It's res d.x. Yeah. But yeah, you know, it's very bad. Like, you know, optimization is really not often, you know, it really lowers your diversification quite a bit. So the thing is, though, what we could do now is effectively to optimize for diversification and maybe have a look what we get. So what we do is we just follow the same process again. We just do the minimization here. And I just use it I just do a copy and paste. And then I just replace our Sharpe with the diversification ratio. So, but everything else is basically the same. So now we've got this, and let's have a look. And so now we actually get an out of sample performance of 0.38 for the not so diversified portfolio. Sorry, this is an in sample performance, and 1.56 for the more diversified one. But what we actually want to do is now we want to see what are the Sharpe ratios. So if we apply these weights now to the out of sample, what are the Sharpe ratios out of sample for our portfolios that are optimized for the diversification ratio? And so let's do that. So all we need to do is we just need to do Sharpe, and then we do SR and REDS2. So this is really it. Oh, sorry, resr.x, because it's the function. And so our Sharpe ratio is 1.09. And you remember that for the previously optimized function, it was much, much lower than that. And let's do the same for div. It's 0.992. So if you remember the out of sample performance for our previous optimized ones was actually, you know, a lot lower. So for example, for the diversified, res d.x 0.92. Oh, that's the same because we actually used the previous one. So if we use the minimizer again, so the original one for our diversified portfolio was 0.7 and 1.08 for the, sorry, res R, and 1.55 for the unoptimized one. So you can see that we have actually improved our Sharpe ratios massively by optimizing our strategy, which is basically the S&P 500, from instead of using mean variance optimization or optimizing for the Sharpe ratio, we optimize for diversification. And suddenly we get actually a much better out of sample performance. So I'm not saying this is a surefire bullet, but this is definitely a way to look at the trading world and actually do something about improving your trading strategies using a different approach than the one is commonly known everywhere. So that concludes my presentation for today. Now I'm very open to answer questions for you. So if you have anything that you're interested, even if it's maybe not, you know, not perfectly related to this, I'm more than happy to answer something today. So there, first of all, someone said, not very familiar with NumPy. Can I get all the job done with pandas? Technically, you can. So I'm sort of using pandas and NumPy interchangeably. I wouldn't say I'm a total pandas wizard, but I would say that you can get most of it done with pandas if you needed to. You would just have to use slightly different operations. And one of the things with NumPy is, for example, if you use the linear algebra package in NumPy, that basically produces you a NumPy matrix So sometimes, you don't get necessarily a pandas output. So you need to somehow juggle that a little bit. But I think if you actually really wanted to, you could do this with pandas. The other thing you could do is you could use sklearn, and there's actually a principal component analysis package in sklearn, and I'm pretty sure that would work quite well with pandas. I didn't use that here because I wanted to show you how sometimes it is quite simple and quite effective to actually build your own code. And you can also actually see at the guts of it, and you can actually understand better what's happening. I like doing this quite a lot rather than just using the black boxes of Python packages, because sometimes you don't really know what they're actually doing. So that can be very helpful. All right. So any other questions? Anyone?
No. So yes, thank you so much for hosting this. And I do have a question. Can you remind me, why did we use the log of returns rather than just like the returns themselves?
So when we actually use the log, what we can do is when you build a log plot, you can often turn the curves of a power relationship into straight lines. So the slope of the line in a log plot is actually the power of the underlying curve that you're plotting, right? And so one of the things is, if we want to quantify, so we've got these two curves with the slopes, right? But if we actually wanted to quantify this, we can't just do like a simple linear regression on those curves. So an easy way to get around this is to log them, and then we get the straight lines, and then we just do a linear regression on the slopes. And suddenly we have a nice metric for our diversification. So that makes that much easier. We could actually use that as well to optimize, by the way. So I just didn't want to do this because it's just a tiny little bit more complex, but we could use this as well in an optimizer. And it's actually giving probably slightly better results than the diversification ratio that I've presented there. So one way or the other, they're both quite good.
And is there any way that we can get access to this file, the Trivial notebook that we've been working on tonight?
Well, I mean, I've just sort of made that up on the go, so it is probably not a particularly great. Maybe it's just easier if you have because the video will be posted on YouTube, so maybe you could just look at the video and just follow along. And anyway, this would be better for you, because if you actually look at the video and then you go through, you'll learn a lot more by actually typing it yourself. Because that's what I found is when I provide people with notebooks, they just click through, and then maybe at some point something doesn't even work, and they go, oh, it doesn't work. But if you actually sit down and type it yourself, you probably have a much better learning experience than following this little bit of code that I've written here along. And so, I think you're better off in the long run. Anything else? So if not, then thanks very much. Oh, Jeff is typing, I see. So very interesting talk. I've not seen use PCA for this before. Have you tried to use this approach to improve robustness for rebalancing portfolios? Well, basically, this is what this is, Jeff. This is actually improving the robustness for portfolios. Now, what you can do here is, for example, if you have a set of alphas or strategies or whatever, you can use this approach to basically rebalance your underlying alpha strategies in a way that you get the maximum diversification and therefore the maximum out of sample robustness, rather than using these strategies just in a very simple, straightforward, equally weighted way. So yes, this is a good approach to do this. And if you give it a try, I think you will see that this gives some interesting results. I could see, Jeff, maybe you send another question, or maybe not. So if there are no more questions, I conclude this. Thanks, Jeff. I appreciate that. Hope you found that quite interesting. I know it's a bit of a complex topic, and it involves quite a bit of linear algebra. So I can see how this can be a little bit challenging. But if you understand this, at least to some extent, it can really, help. And this is really how professionals are looking at the world, that they don't necessarily look at it just in a sense, entries and exits and all that. So they look at a broader picture, what's my underlying stuff doing and so on. So if you can start doing this, I'm sure you will actually improve your strategies quite significantly. So for everyone who was here, good luck with your trading, all the best. And I hope to see you again in the next webinar. All the best. Have a good day.
Thanks, Tom. You too. Bye.
Bye. You're welcome.